Warm welcome to CA Raja classes and thank you so much for joining this mini and micro webinar. Before we get into the discussion, let me just take a couple of minutes to introduce myself. I am CA N Raja, a chartered accountant by qualification, a teacher and trainer by passion, and teacher for 3 lakh plus students worldwide. I started my career as a banker with State Bank of India. Then after a period of 4 years, I got into CA practice. I had my practice for 7.5 years. But I realized my calling is teaching. I started focusing on teaching and training. And today, with the blessings of God, we have 3 lakh plus students worldwide. So now it's time for us to get into the session. I need your participation here. Look at this. There are 3 companies A, B, C, and you have information about their long-term sources and short-term sources, total sources. You have information about their long-term uses, short-term uses, and total uses. I want you to digest this information. Spend some time and then identify which company is in trouble here. Is it company A or company B or company C? Company A, they've raised long-term funds of 50. They've raised short-term funds of 50. So total of 100, of which 50 is used for long term, 50 is used for short term. Company B also raised in the same pattern, but of which 70 is used for long term and 30 only used for short term. And C raised in the same pattern, but of which 30 only used for long term and 70 is used for short term. So you have to tell me like which company is in trouble. Let's see the results. I'm going to rearrange this statement. Let me bring the long-term sources here and I'll compare that with long-term uses. So let's see what is the position. If you take company A, long-term sources and uses are same, so no surplus, no deficit. But company B, long-term source is 50, long-term use is 70, so there is a deficit of 20. And company C, long-term source is 50, long-term use is 30 only, so there is a surplus of 20. And now let me take short-term sources. I'll compare that with short-term uses and let's see what is the position. For company A, obviously no surplus, no deficit. But company B, they raised a short-term fund of 50 and used only 30, they had a surplus of 20. And company C, they raised only 50, they've used 70, they had a deficit. So it might look like company C is in trouble because they had deficit and company B is comfortable because they had surplus, but that's not the understanding. Pay attention here. Company B, they raised a long-term source of 50, but they created a long-term use of 70. How is that possible? With 50, you cannot create 70. So from where they got the remaining 20? Obvious, they got that remaining 20 from here. So this short-term surplus of 20 with the long-term source of 50, they got money worth 70 million, which they have used for long-term purpose. And because of this reason, we say company B is in trouble. Because company B, they raised a short-term source of 50 and their short-term resources are only 30. It means they are supposed to repay 50 million in 1 year. With that promise, they raised 50 million, but what they have done is they have created only 30 million worth of resources. They have simply diverted 20 million for long-term purpose. So within 1 year, they are supposed to repay 50 million, but they have resources only 30 million with them. So whoever have given that 20 million, they'll go for legal action against this company for not fulfilling the obligation, for not fulfilling the promise. In this case, company B, they'll not be in a position to fulfill the promise because that 20 million they have invested in long-term asset. Long-term use. It can be land, building, plant and machinery, and you cannot sell them just like that. It will take more than a year, but they will not wait for more than a year. Okay, that's why we say company B is in trouble. But if you look at company C, they've raised 50 million long-term, they've spent only 30 million, they had a surplus of 20 million. And that surplus of 20 million along with short-term fund of 50 million, they've created short-term use of 70 million. And if you look at it from the other side, within 1 year they are supposed to pay 50 million, and for paying that 50 million, what are the resources they have? 70 million. That's why we say company C is in comfortable situation. Okay, right. So this statement which helped us to get more clarity is fund flow statement. Let me give you a real life fund flow statement. It will look something like this. Okay, it's basically part of it. Look, here you have the sources and here you have the applications. Sources we basically call as long-term sources, application we call as long-term users, like what we have seen here. Okay, now look at this. Let me analyze this also so that you will get complete clarity about fund flow analysis. And here I'm not teaching you how to prepare fund flow statement, but I'm teaching you how to read the fund flow statement. Okay, look, in 2018-19 they had long-term sources from operations and by selling investment of 5,650, and these are all their long-term uses. They purchased plant and machinery, they paid taxes, they paid dividend. Okay, so 5,650 was the source, 6,200 was the use, there was a deficit of 550. Let's analyze this. So what is the total source? It is this 5,650. Okay, when they had 5,650, what they did, they first purchased plant and machinery. Okay, not first, they purchased. Okay, all right. Since they had so much of fund, okay, 3,700 is okay, because even after paying all this, they'll have a surplus of 1,950. And then what they are supposed to do, tax is compulsory, they cannot escape. Okay, from 1,950 they paid taxes of 1,100. So they are left with 1,950 minus 1,100, 850. Okay, when they are left with 850, they did this mistake. When they are left with the long-term fund of 850 only, what they did, they went and paid dividend of 1,400. What is the amount they have? 850. But what is the dividend they have paid? It is 1,400. How? It's not acceptable, right? But they did that. How? They went and paid 1,400. They faced a shortage of 550 and they have managed that shortage by using short-term funds. Okay, so here there is a deficit, and this deficit was managed because they took some short-term funds. A simple example can be a cash credit or overdraft, because they wanted to pay 1,400 to their owners, but they have only 850. So what they did, that 850 plus money available in cash credit or overdraft to the extent of 550 put together, they have paid dividend of 1,400. So this shows their financial discipline. When they have only 850, why they are paying 1,400? That's not right, right? I mean, this is not a wise approach. Or ideally what this business should have done, when they have purchased plant and machinery of 3,700, here they should have raised some long-term funds. So some portion of this 3,700 could have been funded by long-term funds, and that would have left good amount of surplus so that they could have paid this dividend easily. Or the other way is, when they have an investment to take place like this to the extent of 3,700, why they are paying dividend? They could have used this money for funding that, right? They didn't do. They paid dividend when they don't have adequate funds. When they had only 850, they paid 1,400. They simply diverted short-term funds for long-term purpose. So this is what happened in 2018-19. In 2018-19, or ideally they could have done one thing. When they are left with the long-term funds of 850, they should have restricted their dividend to 850. In that case, there will not be any diversion of short-term funds for long-term purpose. But even it should not be like that, no, because there should be some long-term surplus contributing for working capital of the business. Here, instead of contributing, they have stolen the money from cash credit for paying as dividend to the owners. Okay, see how powerful the statement is. It is revealing what was hidden. Let's see what happened in 2019-20. In 2019-20, their funds from operations have improved significantly. They've also raised money by issuing debentures. So it is 7,800. And from that, they are purchasing plant and machinery. Okay, they have a lot of money, let them. It means after purchasing plant and machinery, they have surplus of 5,025. And they want to pay taxes. Okay, good, let them pay. So from 5,025 taxes paid, what is left over now? 3,325. From that, they want to pay dividend. Okay, let them pay 2,250. It means the balance left over is 1,075. At this point, they should have put a break. But what they did, they went and purchased an investment of 1,500. When they are left with the funds of only 1,075, it means this is the grave mistake which they should not have committed. 1075 is the surplus, 1500 investment not in their business. They have purchased investments, some shares or stocks of some other company. By using whose money? By using some short-term money. Look, they have only 1075, but how they spent 1500? The 1075 plus 425 gave them 1500. They've invested in someone else's business. This business is not learning from its mistakes. When they are left with 1075, they should have stopped at that level. They should have ensured that this money is going for supporting the working capital requirements of the business, but they didn't do. Okay, so these kind of all hidden practices will get caught, will get revealed in fund flow statement. In my 4 year of stint in State Bank of India, the statement for which I had high regards is the fund flow statement, because this is one master health checkup report which will reveal all the hidden problems of the borrower. I mean, if at all you will get awestruck, or if at all you will become unanswerable in one statement, means that is fund flow statement, because it is so clear. Okay, because it shows from where they got money, where they have used. See, they have paid dividend in 1819 when they didn't have money. They've invested in someone else's business in 1920 when they did have money. So this all shows the intentions, the integrity of people behind the show as well, not just numbers. It also goes deeper into qualitative aspects. So that's the power of fund flow statement. So develop your skill in reading fund flow statement. Such a powerful statement. Okay, all right. So with this, I wish to conclude this presentation, and I believe most of you would have had a bulb on moment. So if you really had a bulb on moment, please type bulb on.
Thank you for watching this webinar. I am sure you have derived value from this webinar. And if you wish to learn more, I have some good opportunity for you. What is that? Check out.
It is this Credit and Financial Analysis Mastery course, exclusively designed for bankers and for those who want to have bankers' point of view. This is a course which we have developed after a detailed analysis, a thorough discussion with several hundreds of bankers and finance professionals. We have identified what is their exact requirement when it comes to SME and corporate credit and financial analysis. In this mastery bundle, I'm going to give you access to various courses. To start with, we have course number 1, Basics of Credit Analysis. In this course, we have explained the basics of credit analysis through various sections, section 1 to 9. Next comes course number 2, that is how to read balance sheet. In this course, we have explained what is balance sheet, how to read them, how to approach them by using real life financial statements. Then comes course number 3, how to do financial ratio analysis like a banker. In this course, we have explained all critical ratios that are analyzed by the bankers, and we have also explained through case studies. Then we have course number 4, how to do cash flow analysis. So through this course, you will understand what is cash flow analysis, how to do a typical cash flow analysis. We have used case studies, and reference to Ind AS is also included in this course. Then we have course number 5, that is how to do fund flow analysis. This is a critical financial analysis tool, and in this course you will learn what is fund flow statement, how to analyze them from banker's angle, how to prepare fund flow statement from academic angle as well. So overall 5 courses, each 1499. So aggregate price should be 7495, but you are not going to pay that. For you, it's just rupees 2499 for 1 year access, or rupees 4999 for lifetime access. And it is not yet over, you have some more bonus. Bonus is course number 6, how to carry out credit risk rating for non-trading entities. These are all the topics covered in this course. Then course number 7, it is how to carry out credit risk rating for trading entities. Not yet over, you also have access to course number 8, that is how to prepare CMA report for bank loans. It's a comprehensive course which will run for 8 plus 5 hours, and you will learn entire CMA report preparation process. And course number 9, how to prepare cash budget for bank loans. Course number 10, how to assess fund-based working capital. So in this course, you will understand what is working capital, what are working capital credit facilities and how to assess them, what are the key ratios that are related to working capital, and what are the additional key analysis that will be done by bankers on working capital matters. You will get a comprehensive understanding of cash credit, export finance, and there are certain on-demand videos as well. So 5 plus 5, 10 courses of value close to 15,000 rupees, but you are going to get it for 1 year access rupees 2,499, lifetime access rupees 4,999, not yet over. You are going to get access to the 11th course, how to assess non-fund based credit facility. So in this course, you will learn about letter of credit, bank guarantee, its assessment as well. Then comes course number 12, how to do term loan appraisal and assessment, because it's a complex process with a lot many technicalities. So this course covers all in detail. And course number 13, basic elements of loan proposal. So how a typical loan proposal will be, what are the basic elements that are covered in this course. And we have course number 14, case study on credit analysis, various case studies based on practical experience and discussion with various bankers and finance professionals are included in this course. And course number 15, this is about collateral securities, where you get knowledge about collateral securities. So overall, it's 15 courses of value close to 22,485. It's 1,000 plus lectures. You can subscribe for 1 year access or lifetime access as you wish. These are all pre-recorded courses, so you can access them anytime as per your convenience. You can access them in mobile app or desktop, and for you the price is not 22,485, it is rather 2,499 for 1 year access or 4,999 for lifetime access. You can check the link in description, where without using any discount coupon code you can enroll at this discounted price, because it's a discount applied link. And not yet over, you're also eligible for some more bonus. The bonus is access to various ebooks and e-resources. You are going to get access to various financial ratios ebooks, financial management related ebooks. You will get access to financial analysis related ebooks, credit analysis ebooks. Not yet over, you will also get access to other resources like test series, templates, audiobooks, video books, career guidance material, and a bonus resource. Check the link in description and enroll now.